Explainer 10, Gimme Shelter. Hi, John Rothfield with Derivative Logic. Give me shelter, we wish. The construction of new houses wins the award as the most cyclical component of US gross domestic product and also the most sensitive to interest rates. But its prominence as a growth or risk theme is just as cyclical. Before Alan Greenspan took away the punch bowl from the house building bubble of the early 2000s, residential construction share of gross domestic product had averaged 6% over the prior 20 years. Now, another 20 years later, residential construction stands closer to only 3% of the economy. The decline is starker when one decomposes it. Since 2007, the year before the subprime recession, spending on home renovations and the improvement has held its own, increasing by 1.6% a year. But building work on new structures has actually declined by 1.1% a year. GDP over that time has grown by 2% a year. And since 2015, US demographic shifts towards an older population, plus construction costs and changing technologies, have reduced the average square footage of a new single-family home by more than 10%. Two data points that we economists look at encapsulate what seem to be insurmountable difficulties faced by builders above and beyond these longer-term demographic trends. One is the NAHB Wells Fargo Housing Market Index. This is a measure of home builder sentiment. In 2025, that index was 28% below its 40-year average. The prospective traffic of buyers subcomponent was 38% below its long-term average. Very low numbers. Another is the Michigan Sentiment Index for a good time to buy a home. This fell to 17 in 2025. We've been nowhere near that low since 1981-82. Back then, during the Great Inflation, the US Treasury yield averaged 14% and the 30-year mortgage rate 16%. Now, with much lower rates, we're back to those levels of negative sentiment. Over the long term, that sentiment index has averaged more like 75. Now, the US Census Bureau produces a quarterly report called Housing Vacancies and Home Ownership. This report has a number of interesting components. One is the growth rate for new households formed and whether those new households are owners or renters. Another is the home ownership rate, which got overextended during subprime, but right now is back to its long-term averages. The report also estimates vacancy rates for both owned and rented homes. These got to all-time lows in 2023, those vacancy rates, but have since edged up a little. There are a multitude of monthly reports on housing that feed into the financial markets and in some cases to estimates of gross domestic product. One example of this is the new residential construction report from the Census Bureau, which looks at permits, starts and completions divided into single-family and multis. There is also a new residential sales report, also from the Census Bureau, looking at sales, months of supply on the market, and the median price of new houses. The report on existing home sales comes from the National Association of Realtors, including data broken into the 4 US regions, as well as median price, percent of houses that are sold above or below listings, and a realtor's confidence index. New and existing home sales feed into some measures of residential construction. That seems surprising because this is sales, not building. But in fact, higher sales appear to beget a positive construction response going forward. Then there are all the sales and rent price data that are valued for their insights into future shelter inflation. Sources include Case-Shiller, the National Association of Realtors, and Zillow. The BLS has a quarterly tenants rent index which covers marginal new renters and an all tenants rent index which measures the average of all existing renters. Finally, to establish the underlying soundness or otherwise of the sector, the Fed looks at measures of mortgage delinquencies and in its quarterly senior loan officer survey looks at trends in demand for and supply of mortgage origination. In summary, in the housing space, lots of data. For inflation, I would be following rents. For economic activity, it would be starts and sales. If I were looking for two summary indicators of the general state of housing, it would be those I'd initially mentioned, which is the NAHB Sentiment Index and the University of Michigan data on the buying and selling conditions for new homes. As of 2025, these are both showing historically low readings and suggesting that borrowing costs, demographics and crowding out from the rise of AI and its demand on electricity and water will be keeping this industry running at below potential. Please let us know if you have any other topics that we should be covering in our Explainer series.